Recall the value-based management slides we reviewed back in Module 1. For the last 6 weeks, we have been discussing the different types of decisions that managers make, namely operating, investing, and financing. Operating decisions impact sales growth, such as should I accept a special order at a lower price? We discussed that in Module 2. They also impact operating profits. For example, how much is this unused capacity costing me and what can I do to reduce those costs? We discussed that in Module 3. Finally, operating decisions also impact income taxes. For example, what can I do to save taxes? But tax decisions were outside the scope of this class. Investing decisions relate to how I invest my money in assets, such as working capital decisions. For example, should I allow my customers to pay with credit? We discussed that in Module 4. Fixed assets are another investment that warrants decision making. For example, should I lease or buy some equipment? Which was also discussed in Module 4. Finally, financing decisions were discussed in Module 5 and included things like, should I fund my business through debt or equity? Recall also that the sum of operating and investing decisions should result in a profit, and financing decisions result in cost. If the profit exceeds the cost, which is the case in viable businesses, that's when shareholder value is created. Now, how do we measure shareholder value? How do we know if shareholder value was created and how efficient we are at creating it? We rely on financial statement analysis to help determine this. In your reading for this week, you learned about financial statement ratios, and I'm going to take a few minutes now just to walk through some of the key ratios and what they mean. But before I do that, I want to talk about a few things. First, you definitely should have an understanding as to how to calculate these ratios. But what is even more important is knowing what they mean. Now, you're going to be using these ratios not only in this class, most likely in practice, but also in other classes in your program. Also, in practice, there's no correct formula per se. The actual formula for a ratio may vary depending on the needs of the person performing the analysis. You may find that in practice that each company may modify the formula for the ratio slightly, but these modifications I'm referring to should not change the overall meaning or the expected direction of the ratio. Let me give you an example. One company might find it really important to calculate profitability using pre-tax income instead of net income. It would still be a measure of profit, just a pre-tax measure. My only point of mentioning this is that we will review the most commonly used formulas for these ratios. However, you may encounter slight revisions to these when you see these in action. The last thing I want to stress is that when looking at ratios to analyze a company, you should look at the ratios over time or compare them across companies, or both. This provides more perspective and allows you to see trends. Looking simply at the ratios for one company in isolation or 1 year in isolation does not give you a perspective on whether they improved or not, or how they're stacking up to their peers. With that said, let's take a closer look at some of these ratios that we're going to use to measure shareholder value. The slide in front of you depicts some of the key ratios and how they relate both to shareholder value as well as to 3 management decisions. I've not included all the ratios from your reading here, but instead I've included some of the ones that I think are used most in practice, and the ones I think, frankly, are the most important, and those are the ones I'm going to focus on. Also, before we go any further, you should note that the ratios here can be helpful in all 3 categories of decisions, but what this table tries to do is depict where they may be used the most. But remember, shareholder value is measured by 2 things: growth in the market value of the stock and dividends. An indication of a company's ability to pay dividends, as well as an indication of how a stock will perform, is measured through the return on equity ratio. Return on equity is net income divided by average stockholders' equity. This measures the efficiency with which the company manages its stockholder investments. Now, return on equity can be broken down further into a return on assets and a capital structure leverage ratio. Now, I'm not going to go through the math behind all of these ratios right here. Your book does a great job of explaining that, so I'm going to refer you to page 129 of your Wiley custom text for further detail on the math. Now, from the return on asset ratio, we can measure operating decisions through a profit margin and also through the average tax rate, also known as the effective tax rate. The book calls it average tax rate, but I think in practice you're going to hear it more commonly referred to as effective tax rate. We can measure investing decisions through asset turnover, which looks at all assets, or we can look at individual categories, fixed assets, and then working capital, accounts receivable, inventory, and accounts payable. From the capital structure leverage ratio, we can measure a mix of investing and financing decisions through the current ratio and quick ratio, which both look at current assets, or where your money's tied up, but they compare those to the current liabilities. Finally, the debt to equity and the interest coverage ratios are measures of financing decisions. Now with this introduction, let's dive deeper into each of these ratios.